Hey everyone, in this class, we are going to talk about accounting for receivables. And specifically, we are going to talk about how to account for accounts receivable, how to account for notes receivable, and how receivables are reported on the financial statement. So if you still recall from the previous class, we talked about sales. And when sales are credit sales, we have receivables. So what are receivables? The definition of a receivable is very simple. Those are amounts due from individuals and companies. So basically, those are amounts due. And why are receivables important? Receivables are important because they represent one of the biggest, most liquid assets of the firm. And here are some of the examples. And as you can see that depending on what kind of firm it is, for some of the firms, those receivables is a really important asset. For example, for Ford, for GE, receivables is around 40% of its total asset. And receivables come in different types. We have different types of receivables. One type is called trade receivable. The other type is called other receivables. Trade receivable are basically receivables result from sales transaction, and other receivables are receivables not result from the operation of the business. There are two kinds of trade receivable. One is called accounts receivable. The other is called notes receivable. Accounts receivable are basically amounts customers own on account, and they result from the sale of goods or the provider of service. They are usually expected to be collected within 30 to 60 days. And notes receivable is different from accounts receivable. Notes receivable, they usually come with a written promise for amount to be received. So they usually come with a formal written promissory note. And they normally require collection of interest. For account receivable doesn't involve interest, but for note receivable, they usually come with interest payment. And then they can be extended for a time period of 60 to 90 days or longer. So they are usually longer periods. Those are account receivable and notes receivable. And examples of other receivables, for example, interest receivable, advances to employees, income tax refundable, those are receivables, but they have little relationship with the major sales transaction of the firm or the line of business of the firm. Let's first look at account receivable. And for account receivable, we have already talked about the basic accounting for account receivable when we talk about sales. And here it's just a reminder for you. So all of those, this example, you can just do it because we have already talked about all of those journal entries in the previous class. So please spend 5 minutes. Try to write out those journal entries on your own, and you can pause your video for now. So company A on July 1st, on July 1st, sells merchandise on account to company B for $1,000, and the term is 2 out of 10 and out of 30. On July 5th, company B returned merchandise with a sales price of 100. On July 11th, company A received payment from company B for the balance due. And what are company A's journal entries? So the first journal entry, when the firm sell those merchandise on account, the journal entry is to debit account receivable, credit sales revenue for 1,000. And then when company B returned the merchandise of 100, we debit sales return and allowance and credit account receivable. And when the firm makes the payment was made within 10 days. So the firm is going to give 2% discount. And this 2% discount is given on the unreturned good, so which is 1,000 minus 100. On this $900 good, we're going to give 2% discount. So the total amount of discount given is $18. Account receivable, the original balance was $900, and the actual cash received is that $900, take out $18 discount. So that's 882. So we debit cash 882, debit sales discount for $18, credit account receivable for 900. So this is the first example. And then, so those three journal entries, we already talked about those in previous class, but here is something new. Sometimes receivables are going to be uncollectible. Sometimes sometimes the client whom the firm is giving that credit term to turned out to be maybe going into bankruptcy, and they're not able to pay those account receivable back. And how to deal with it? So when receivables become uncollectible, there are two methods to deal with it. Accounting-wise, one is called direct write-off method, the other is called allowance method. So let's first look at the direct write-off method. This method is very simple. We basically write off the uncollectible as it occurs. So if a client come up to you and tell you, hey, so I'm not going to pay you back, I'm bankrupt now, and then you write off the uncollectible from that client. The journal entry is to debit bad debt expense, credit account receivable. And this situation, the direct write-off method, this is not used very often. Unless the bad debt loss was insignificant, we do not use this method. So this is only used when the bad debt loss was really insignificant. However, for all of the other situations, we need to use the allowance method. Under the allowance method, we need to estimate the uncollectible account at the end of each period and record this estimated amount in the same period when sales occur. So whenever we make a sales, we need to estimate out of this sales, how much is going to turn out to be uncollectible in the future. And then we need to record this estimated amount. And the company must use allowance method for financial reporting purpose when bad debt are material in amount. With regard to this allowance method, there are three journal entries involved. The first journal entry is to record estimated uncollectible, and we debit bad debt expense, credit allowance for doubtful account. The allowance for doubtful account, this is a contra account to account receivable. Bad debt expense, this is an income statement account. This is an expense account. The second journal entry is to write off of an uncollectible account. So sometimes firm may think, hey, so previously this is just an estimation. But after a while, the firm may notice that, hey, so this uncollectible has been outstanding for half a year. Maybe we will never receive it. And then in that situation, the firm needs to write off this uncollectible account. It's not going to be on the firm's book forever. In order to write it off, the firm is going to debit allowance for uncollectible account and credit account receivable. So this is no longer going to be a receivable for the firm. At the same time, it is taking out the allowance for doubtful account. So this journal entry is not going to impact the firm's income statement. The bad debt expense was already accrued here. And when the firm write off the uncollectible account, it's not going to make the firm's net income go down. So it's not going to impact the firm's income statement. However, a third situation may come out that the firm may have already written off an uncollectible account, but sometimes maybe one day the client come up to the firm and actually pay the firm back. So what shall we do when the firm, this is called a recovery of uncollectible account. So what if we have already written off an uncollectible account, and then after a while we got paid for that account which was already written off. And in this situation, this means that our previous written off was wrong. So we need to reverse this journal entry by debit account receivable, credit allowance for doubtful account. And at the same time, because we receive cash, so we debit cash, credit account receivable. So those are the three major journal entries which relate to this uncollectible account. And now let's look at some examples which explain each of those journal entry. First of all, to record estimated uncollectible. For example, company A has credit sales of 1.2 million. Of this amount, 200,000 remain uncollected at the end of the year. The credit manager estimates that 12,000 of those uncollectibles those uncollected receivable will be uncollectible. And what is the adjusting entry to record the estimated uncollectible? So the estimation is 12,000 is going to be uncollectible. And then we just write the journal entry, debit bad debt expense, credit allowance for doubtful accounts for 12,000. Bad debt expense, this is an operating expense. And allowance for doubtful account, this is a contra account to account receivable. So basically on the firm's financial statement, the number which is reported here, this is net account receivable, and this is equals to the total account receivable minus allowance for doubtful accounts. So this is the first journal entry. And then the second journal entry is to record write-off of an uncollectible account. So for example, financial vice president of the firm authorized a write-off of 500 banners owned by company B. And what is the journal entry to record the write-off? The journal entry is to debit. We're going to decrease the allowance for doubtful account. At the same time, decrease account receivable. So this is no longer going to be recorded as a receivable for the firm because the firm has given up like collecting those receivables. And this journal entry has no income statement effect. It's not also the net account receivable is going to stay unchanged because where decrease account receivable at the same time decreases contra account. The third journal entry is to record recovery of an uncollectible account. And what is recovery? So recovery is collect from a customer after writing off the account as uncollectible. And if we continue the previous example, suppose company we wrote off that $500, and then company B pays $500 that the firm has written off. So what is the company A's journal entry? Company A's journal entry, they need to first reverse the previous journal entry by debit account receivable, credit allowance for doubtful account, and then to record the collection of cash, the collection of this account receivable by debit cash, credit account receivable for $500. And this journal entry has no income statement effect. So we have just talked about the journal entry for recording bad debt expense, which is debit bad debt expense, credit allowance for doubtful account. But then another question is, how do we determine what is the amount to debit and credit for those two accounts? To determine the amount to debit and credit for those accounts, we use a method called percentage of receivable method. So there are also some other methods, which if you go to take more advanced, like intermediate financial accounting one, they're going to talk about as a method. But for this course, we're only going to cover one method, percentage of receivables method. And under this method, we estimate the allowance for doubtful account as a percentage of the outstanding receivables. What do we mean by this? Suppose the company A has an ending balance in account receivable. So account receivable ending balance is 200,000. And the unadjusted credit balance in allowance for doubtful account is 1.5 thousand. It estimates 5% of its account receivable will eventually be uncollectible. So the account receivable balance 200,000. 5% is going to be uncollectible. So it's going to be 10,000. And the firm has only accrued for a balance of 1,500. So what we need to do is we need to make a journal entry to, make the balance for allowance for doubtful account to go from 1,500 to 2,000. And how do we do that? So the difference between those two is 8,500. We debit bad debt expense for 8,500, credit allowance for doubtful account for 8,500. And this is the journal entry. So sometimes to more accurately estimate the ending balance in the allowance account, companies may prepare some aging schedule. What do we mean by this? So this is the total account receivable balance, and this balance is made up of receivables from different people. And for different receivables, they may be due for different amount of time. So for example, for this receivable, which is due over 90 days, it has a higher probability of default. And for this receivable, which has not yet been due yet, it may have a lower probability of default. So what we do is we separate those different receivables into different age schedules, and then we multiply them by different probability of default. So for example, this 300 multiplied by 40%. So this is 100 plus 300 plus 1,500. So it totals to 1,900, and we multiply it by 40%. It's going to give us 760. So, and then we just take all of the, we take the receivables in different age schedule and multiply them by the correspondence default estimated percentage default rate, and then we add them up. So this is going to give us a more accurately estimated balance for allowance for doubtful account. And we need to get to this balance, but we already has the allowance for doubtful account already has a credit balance of 528. So how to get from this number to this number? The difference is 1,700. So we debit bad debt expense for 1,700, credit allowance for doubtful account for 1,700. So this is how we estimate the amount. And so we have talked about the basic journal entries for account receivable, and how to take care of uncollectible account, how to estimate those amounts. And companies sometimes they may sell their receivables to other companies for cash. Companies may do it for different reasons, and one reason is to shorten the cash-to-cash operating cycle of the firm. If the firm sells those receivables, they're able to get cash back earlier. And this is called factoring. So the sale of receivable to a factor. What is a factor? Factor is a finance company or bank that buy receivable from business and then collect the payment directly from customers. And then factors, those finance company or bank, they usually charge a fee to the company that is selling the receivable. Here's an example. For example, company A factors 600,000 of receivables to company B. Company B assesses a service charge of 2% of the amount of receivables sold. What is company A's journal entry? So company A factors 600,000. Account receivable is going to decrease by 600,000. And then, however, the amount of cash the firm received is 600,000 minus 600,000 multiplied by 2%. And this is the service charge charged by the bank in order to offer this factoring service. And the rest, this 12,000, this is goes into the firm's income statement as a service charge expense. So this is the basic journal entry. And factoring is actually very common. So if you ever use credit card in a supermarket, the retainer's acceptance of a credit card, that is one form of selling, factoring the receivables. So the retainer, for example, Target or any kind of retainer, they typically pay the credit card issuer a fee of 2 to 4% of the invoice price for its service. Yeah, so this is one type of factoring. What is happening here is if you use your credit card in Target, and Target is going to receive money from the credit card issuer, and issuer is going to take care of giving you credit, maybe allowing you 30 days to pay it back, and take care of all of the collection from you in the future. But in return, Target is going to give the credit card issuer a service charge, a service fee. Here's another example. Joe purchased 1,000 of compact disc from company A using its credit card. The first bank charged a service fee of 3%. What is company A's journal entry? So company A, by sending this disc to Joe, it is making a sale. So that's a sales revenue for the firm, $1,000. And then the credit card company is taking 3%. So that is $30 as the service charge. And company A is only going to receive 1,000 minus 30, so $970 in cash. So this is about account receivable. And next, we are going to talk about notes receivable. What is notes receivable? Notes receivable are basically receivables that is supported by a formal promissory note. So what is a promissory note? Promissory note is a written promise to pay a specified amount of money on demand or at a definite time. And here is an example of a promissory note. So it's going to have the amount of money, the date, the due date, the payee, whom the money is going to be paid to, the interest rate, and the maker, who's the who's the payer of the of those money. And then there are two important items for a promissory note. One is the maturity date. The other is the interest rate. So the maturity date, there are three ways to state the maturity date of a promissory note. It can either be stated as on demand. So I'm promised to pay this amount of money on demand. Or it can be stated as on a certain date. So I promise to pay this amount of money on July 23rd. It also can be stated as a period of time. So for example, I promise to pay this amount of money 1 year from now. So those are the three ways to state the maturity date of a promissory note. And when we are counting days, we usually omit the date the note is issued, but we need to include the due date. Another very important item on a promissory note is interest. So if a note is interest bearing, interests are usually calculated as the face value of the note, multiplied by annual interest rate, multiplied by time in terms of a year. So an example is, for example, if it's a $730 note, and then the interest, which is stated on the note, is $12, and this is the annual interest rate. Well, the note is only outstanding for 120 days. So we need to take 120 days and divide it by 360. If it is only outstanding for 6 months, we need to take 6 months out of 12 months. If it is outstanding for a year, that is 1/1. So this is how we calculate the interest that is going to be paid. And here's an example. So company B wrote a $1,000 2 months 12% promissory note dated May 1st to settle an open account with company A. What is the journal entry that company A makes when it received the note? So this note is a $1,000 note, and this is to settle an open account, a previous account receivable the firm has with company A. So basically what we do is we decrease account receivable $1,000 and we increase note receivable for $1,000. And after the firm has issued, after the firm has received a note receivable, two things may happen. The maker of the note can either honor or dishonor the note eventually. If the maker honored the note receivable, so a note receivable is honored when its maker pays in full at the maturity date. And here is an example. Suppose company A lends company B $10,000 on June 1st and accepting a 5 months 9% interest note. Company A presents the note to company B on November 1st and received the payment. Company A's accounting period end on December 31st. So what is company A's journal entry on November 1st? On November 1st, company A received the cash. So this is the face value. Sorry. Plus interest. And then previously, when the note was received, it is a debit to note receivable. And when it matures, when that note receivable, when company A present a note receivable to company B and receive cash back, we need to decrease the note receivable because the company has already received it in cash. It's no longer a receivable for the firm. We also need to recognize the interest revenue that is on this note. So the interest revenue is calculated as the face value multiplied by 9%, the interest rate, multiplied by the fraction of the year, because this note was outstanding. It was issued on June 1st, and then it matures on November 1st. So that is 5 months. So this is the annual interest rate. And then we multiply it by 5 months out of 12 months. This is going to give us 375. And then the total cash received by the firm is 10,375. So this is when the maker honors the note. And in another situation, so in the previous situation, the accounting period ends on December 31st. So the firm actually, even though it's been 5 months, but because the firm doesn't need to prepare its financial statement, so it doesn't need to accrue for the interest that has been accumulated on the note before those interests are paid back. However, in some other situation, what if the accounting period ends before the note matures? And in this situation, we need to make an adjusting entry on the accounting period end date to accrue the interest earned but not yet received. So if we continue the previous example, suppose company A's accounting period end on September 30th. What is company A's journal entry on September 30th and November 1st? On September 30th, even though company A hasn't received anything yet, but because the firm, it's already been 4 months, the firm has been holding this note. So the firm actually the firm has already earned interest on this note. And how much interest? The face value is 10,000 multiplied by 9%, multiplied by 4 months out of 12 months. So that's going to give us $300. And those should be recorded as interest revenue for the firm. On November 1st, when the firm received cash, it's going to decrease its note receivable for $10,000, the face value of the note. It's going to decrease interest receivable because now those interests are received. And it's going to record the interest on the last month of the firm is holding this note. So 10,000 multiplied by 9%, multiplied by 1 out of 12. That's going to give us $75. So the previous situations are when maker honored the note receivable. How about when maker doesn't honor the note receivable? A dishonored or defaulted note, it is a note that is not paid in full at maturity. And here's an example. So so this is suppose the financial statement date is December 31st. And on November 1st, company B indicates that it cannot pay at the present time. What is company A's journal entry? So company A's journal entry here, depending on what company A's belief is. If company A expects eventual collection, so even though company B indicates it cannot pay the note, but company A, even though company B indicates it cannot pay the note, but company A may think that they're still able to receive those collection from company B eventually. So if that is the case, then we debit account receivable, credit note receivable, and interest revenue. So in other words, instead of debit cash, we debit account receivable. It's going to be moved into account receivable account. However, if company A does not expect eventual connection, if company A think that it's never, if company B has already indicated that, then company A just give up connection. It's not expect to connect this from company B eventually. Then the journal entry company A is going to make is to debit allowance for doubtful account and credit notes receivable. It's not going to record interest revenue because company already think that it's not going to collect it from company B. So here are the two situations. And we have talked about accounts receivable and notes receivable. So how are receivables presented on the financial statement? Here's an example from John Deere's. And as you can see here that we have receivables. So all of those are receivables of the firm, and they are presented at its net value, which is receivables minus allowance for doubtful account. And this is also called the net realizable value of those receivables. So they're reported at the net realizable value. Yeah, so this is all for this chapter.